My name is Akshay Mehrotra. I'm co-founder and CEO of Fibe, India's largest consumer lending app for salaries professionals.
Lending is big business. In advanced economies like America and Japan, almost 2x of the GDP is the amount of uh, loans in the economy, which means that if the country produces $100 worth of goods and services, there are $200 worth of loans that exist in that country. In India, this number is just zero point 0.5 of GDP. So you can imagine that there is so much opportunity in the lending space in India. In this episode of the Founder Thesis podcast, I'm speaking to Akshay Mehrotra, the founder of Fibe. Fibe is one of the largest digital lending players in the unsecured space. There are a lot of jargons that we use in this episode, and I break down those jargons as I talk to Akshay to help an outsider understand all about the lending business, which is a highly complex, highly regulated business. If you really want to get a deep dive understanding of what lending businesses are all about, then this is a must listen episode. I'm Akshay Dutt, and you're listening to the Founder Thesis podcast. So, could you give me an elevator pitch of Fibe?
Sure, Akshay. Hi. Let's give you a quick elevator pitch of what Fibe is. So, when young people really wanted to figure out credit, we said that can we solve this problem to introduce the country's first product to introduce credit to salaried professionals? Today, anyone who's young, as long as he's salaried, if he needs money, we'll make sure that he can get a credit line approved in a minute and get, let's say, a 50,000 rupee transferred within the next 10 seconds to him. So, Fibe is the largest, fastest lending product available in Asia. It's meant for young Indians. It's meant to be simple. It's meant to be very rationally priced, much cheaper than a credit card, available runtime within a couple of seconds.
Okay. You're saying fastest in Asia. Uh, how have you validated this?
We given our average loan dispersal window as 122 seconds.
Wow. Okay. And this is a number that all other fintechs also release, like how much time it takes them to disperse, or this is like a estimate based
Let's
on you
say,
being an industry insider.
well, when you become market leaders, you set the benchmark. Everyone
Okay.
else
Okay.
follows then.
Okay. Okay. So you're market leaders in what would be unsecured personal loan. That would be the category of the product, right?
Yes. Yes.
Okay. Okay. So unsecured because there's no collateral here, unlike say a home loan where there is a collateral.
Correct.
So
Correct.
this is if you need money for no matter what reason, you can just come and go through some sort of an assessment, and you will get the loan. And the average time to get the loan is 122 seconds.
Correct.
Okay. Okay. So when you say you're largest in the country, can you give some numbers to help me understand what that means?
So typically in any given month, we do close to 900 crores of disbursal. We are working with at least 700 active borrowers at any given time. We receive more than 2 million people coming to us each month, and we're able to service, let's say, at least loans worth 12,000 crores on the platform each year. That makes us the largest lending product to salaried professionals, under 200,000 rupees being delivered digitally, in almost operating in 321 cities.
Okay. So when you're saying largest in India, the caveat or the star there is that this is for digital players. In the digital player
Correct.
ecosystem, you are the largest. So in the non-digital, it would be like a bank which would have a bigger loan book than you, like a
Oh, of course.
ICICI Bank or those kinds.
Very interestingly, see, in banks, you can't be really large as a financial entity. 1% means you're HDFC Bank. Right. So that just sets a benchmark that even if a bank is really big, he's a mammoth, 1% of lending in the country means your HDFC Bank.
Wow.
Right. So
Okay.
India is a
So
very huge market. Everyone
mhm,
finds their niches.
mhm.
Our job is to find a niche which is addressable and really build an ecosystem behind it. Today, if I look at the niche that we cater to, we are catering to salaried people. There are almost 220 million households that we are talking to. These are 100% salaried, 100% banked customer, but not being able to bank. borrowed from yet a bank. They've not got access to a credit card. They've not been able to get an access for a larger loan. And that's what we provide access at an early age so that they can start using credit for improving life every day.
Okay. So, are you saying that you give loans to new to credit customers, like customers who don't have a CIBIL score? Like
So
that
we
would.
also give loans to a customer who's new to credit. But having a bureau is not the reason why we give you a credit. We love people who have just started their jobs. In fact, when you walk into many large companies, typically the HR intimates us that my employee is joining, help him with a small loan so he can pay his house deposit. It could similarly be you're just passing out of a campus and you're coming into, let's say, Bangalore to pick up a job and reach out to get credit from us. It could be a 2, 3 years old, been working somewhere. You have tried a couple of credit products, but you haven't really been able to access to quality credit yet. Typically, you're borrowing from very expensive instruments, or the only thing that you tried was, let's say, buying a mobile phone on EMI. Will become your first credit product to use you better. But over time, what we have noticed is that a consumer who's young, let's say typically between 24 and 30 years old, we're able to service him the best. We're able to give him a right amount of money, and we're able to get him to accept a credit product really as a everyday lifestyle product. And that's what we're really focusing on.
Okay. Uh, so, when you're saying that a young person who's not had access to quality credit products, so it means like instead of taking a loan, they're just using their credit card and revolving that, or rather
Yes. So
extending
credit
it.
cards are phenomenally expensive, as one
Mm.
example. Let's say 30% of our customers who come to us maybe have experienced a credit card before, but they get over leveraged on it. Credit cards are also very expensive. Credit limits are very muted. But let's say 18 months down the line, most of our customers have a credit card for paying through credit card. What we want to avoid is getting over leveraged there. What we want to avoid is revolving on the card because card revolve is very expensive, right? And so it's a two-way part. We acquire a customer who's not experienced credit, but as he matures, he will access more credit products. We try to make sure that he's now borrowing more rationally, not getting over leveraged, and getting the right amount of money.
And what would the credit cost through Fibe as opposed to through a credit card? What's the difference?
Uh, let's give a benchmark example. Typically, let's say a consumer taking a 12-month product on our platform, which is like a cash withdrawal directly into his bank versus a credit card cash withdrawal, we should be at least 40% more rationally priced than the credit card product. The consumer pricing could vary from, let's say, 18% to 24% interest in a 12-month product. So it's very competitive. And he finds it much better. Credit cards not only are more expensive, they also, the interest on a credit card attracts GST. So it's always going to be 18% more expensive.
Wow. Why is it that credit card interest attracts GST and not a personal loan interest?
Well, that's how financial markets operate.
Okay. Okay.
But credit card is a instrument. You're not supposed to be using it for. It's a transaction instrument, so it requires different type of interest and different type of charges on it.
Mhm. And I think credit card interest is typically 3% a month, like 36% annual.
Almost 3.5% a month plus
Three and a half.
GST.
Okay. All right. Yeah. Plus GST. Okay. Okay. So credit card as a source for shortfall, like making up shortfall in your cash flows, is like phenomenally expensive. So Five is a much
Yes.
better option.
And
Okay.
most of the time, it's more than cash flows, right? It's the right amount of money which is important. I would say typically a consumer, we're trying to give him, let's say, 60,000 rupees, which is close to 1.5 to 2 months of his salary. So it's not just tying over the month, it's actually to have meaningful money coming to him.
Okay. In a credit card, if your salary is at 30,000, your limit will also be something around that, I guess. The
Correct.
Okay.
And most of the time uh, you think that you end up paying minimum balances on a card just to survive the cash flow because you're not getting hard cash from it. While we give hard cash, you can pay off your card, you can do something meaningful with it, and then pay over time or installment.
Mm, okay. Uh, you said that you give a credit limit. So is it like a limit where I can choose how much cash I want to take out from it, or is it like you
Yes.
give a loan
So,
and that loan is disbursed?
so it's both. Let's give an example. You have a credit limit, let's say of a lakh 20,000. you could choose to withdraw only 80, but it's only a one loan created at one time, which means unless you pay off the 80,000, the limit will not get reactivated.
But your
So it
interest will
can't.
only be on 80,000. You'll not pay interest on the
Absolutely.
remaining 40.
Absolutely. And one
Okay.
of the most interesting parts that we run is we charge daily, and we say, and we have no prepayment penalty, which means that if you took the 80,000 rupees on, let's say, 9th of the month and you decide to pay back on the 31st of the month, you're only going to pay 21 days interest and no other charge.
Amazing. Are there other companies which offer this kind of a daily interest product?
I think mostly no. Most of the companies, while they calculate interest to it monthly, they also don't provide, let's say, flexibility to prepay without penalties. If you remember, when you borrow large loans from private and public banks, they attract large prepayment penalties, almost 4 to 5%.
Mm.
So they focus to make sure you survive the 3 to 4 year tenure. While we believe the day you have more cash paid back, you'll come back and again borrow. In fact, let's say 5 day repeat rates are almost 80 odd percent for us. So people
Five
come back and
day
retake
repeat
again.
rate. What is the 5 day here? Sorry, 5 day repeat rate.
So you paid the loan today, within 5 days, you
Okay.
come back and again borrow.
Okay. And how much did you say? What is the percentage there?
So today our overall repeat rates are crossing 88%.
Wow.
So we have I again put this benchmark to say, I think we have one of the highest repeat rates financial services ever seen in the country. And I think this is because when the consumer comes back, he sees a better product. He sees even a lower yield product for him. And he sees a 1 second product, which means open app, enter OTP, money transfer.
Mm. Okay.
So which is a very
Fascinating.
interesting journey that he experiences.
Okay. So essentially, you are an alternate to a credit card in every sense of the word. Like there is flexibility. You get a limit of which you only pay interest on the amount that you need, and you
That's
can.
one component of the product, right? Credit cards provide credit on demand for a specific segment. Let's say 40% of our customers will never be eligible for a card. So we have a line of credit for those customers. We're also a more rational price personal loan for shorter needs. Let's say there is a, let's say, wedding in the family and you need to travel for that, right? Going, coming, trousseau, uh, and gifting, etc., will cost you 50,000 rupees. There is no personal loan for that. Typically, you'll end up borrowing 3 lakh rupees from a bank. They won't give you less than that. What we allow is the flexibility. Take 50 today if your salary comes on the first payback. Otherwise, it comes in a, let's say, minimum 6 month EMI.
Okay, so because banks have the infrastructure costs, so they are not interested in giving us low ticket size loan, and
Absolutely.
that is what you are able to do. Okay, so
Absolutely. Right.
yeah, what is your book size? Like the uh, assets under management, is that the right term?
Yeah, that's the right term. So today our AUM is crossing upwards of, let's say, 330, 200 crores. Uh, uh, our book is linked to not such large tenure, so it's difficult to build a larger AUM in our business. Today, we have crossed, let's say, the 3,000 crore mark. What's the good component? Is this book is also a very singular customer type originated. It's 100% salaried customer, right? So it's very interesting that how you build a book behind a similar customer type and a similar product type, which allows consistency and understanding of risk in a better manner.
Okay, so like your prediction of what will be the default rate is better than somebody who has a diverse book where they're lending to business owners and people in unorganized sector and people who are working in organized sector getting salaries. So they would have a less predictability of what will be the NPA. So you're able to price it better. Like,
Yes, and that's the reason because of the customer segment choice is interesting. It's a large segment. Let's say we are able to grow 2.5 times a year in that segment. While we are growing, we're able to control credit cost. And more importantly, as you keep retaining the customer, you can predict what's going to happen at the end book. So end of the year, you need to build a book which is profitable. At the same time, the yields are low, and the margin model and let's say ROA efficiency is much better on it.
Can you explain some of these terms? You said yields are low,
So
margin
yields
what?
is,
Yeah.
let's say, the net IRR for the customer. Many of the times people try to price out the risk. So you'll find many products in the market who try to mimic us, but suddenly you say why the cost of that product is almost twice our cost, because he could understand risk in that manner. He tried to price his risk out, right?
Okay.
Because he's trying to do every segment and then trying to enter our segment. The second is the consumer comes and says, listen, I need to borrow rationally. Typically, let's say if you're borrowing 20,000 rupees from us, um, I think the per day interest cost comes to 12 rupees a day. So customer also says, listen, I need money, but I only need for a few days. Let me try to understand what that cost is. I may not drink one coffee. It may cost me 200 rupees, which means I can get that 20,000 rupees for nearly 20 days. He, in his mind, starts calculating in that manner.
Right, got it. Okay. So because your NPAs are predictable, so you are neither leaving money on the table nor are you overcharging, because you can very precisely predict that this will be my NPA. And just for people who don't understand why NPA prediction is important, is because the interest you charge a customer is your cost of interest plus your margin plus what you predict as the NPA would be. Am I right in my understanding?
Yeah. So see, there are three parts of the NPA, right? The first is looking at what is my cost of borrowing, what is my cost of, let's say, risk. I add those two and I subtract from what I charge from the customers. That gives me the contribution income coming in. And then comes, let's say, my overhead costs, etc., coming in, right? Typically, if you look at any business which can contribute upwards of, let's say, 14, 15%, or nearly 40% as contribution income to it, it becomes a very healthy business. And any business, at the end of the day, it's built on, financial businesses are built on leverage, right? So I have 100 rupees, but can I go and lever 5x against it? When I'm leveraging that business, can I operate of upwards of 5% ROA? Right? That becomes very important. And I think we are modeled ourselves to say we are like a credit card business. ROA efficiency is close to 6%. And that's what makes the business very interesting from financial services markets, right? You're building a business which can lever quite well. You are attracting a customer segment where you can predict risk, so you know what your outcome you're chasing every time. And if you're able to borrow and lever well, you can build a healthy revenue line, and you can also be remaining very heavy in profit lines also.
Okay. So uh, I'm just kind of like summarizing my understanding. If you have 20 rupees as your equity, you don't necessarily need to restrict what you're lending to 20 rupees. You can also borrow 80 rupees more and then lend out 100 rupees. And the
Absolutely. And
80
that's how you
rupees
make money. If you make
mm,
only on 20, you can get ROE, right? But
return on
this is
equity.
a
Yeah.
ROA business, right? Where you
Mm,
borrow from someone else and you get much higher returns.
mm,
Typically, let's say the ROE in a financial services lending model should be upwards of 22%. Right. And let's say
mm.
some of the credit card businesses, and let's say Bajaj has come an example where they can do upwards of 26, 27%.
Wow.
And that's why they become very profitable. And that's because they're able to lever well. They're able to lever more than 4 times,
Mm.
which gives the
Okay.
efficiency on the model coming in.
Okay. So when you're saying 5% should be your ROA, which means that that 100 rupees, which includes 20 of your own money, 80 of borrowed money, should give you a net margin of 5%. So you should earn 5 rupees
Correct.
out of that, which 5
Correct.
rupees, if you look at return on equity, then that's like one fourth. So it's like 25% return on your
Absolutely. That's how
equity.
it gets added up, right?
Hmm.
That's how it gets
Okay.
added. So that's how
Okay.
these businesses are modeled to be uh, very interesting, scalable, and that's why they can attract, let's say, more debt. And whenever you attract more debt, then you're able to build larger businesses behind.
Hmm. What is the multiple for you? Like you said, Bajaj is able to get 4x. So which means if
So
Bajaj has
Bajaj is
20
actually able to do
rupees
more
of
than
its own,
5x. Yeah, they're able to do
more than 5x.
5x.
Wow.
Yeah.
Okay.
And I think
So
this is what is interesting in fintech, right? I think the regulator also changed a lot to make life better on leverage. Uh, there are two ways of leveraging today. One is directly on your own balance sheet. So we own an NBFC and that's a lender. But we also do co-lending with other institutions, which allows us straight away 5x lever. Right. So while we are building, let's say, better rating and better acceptance from lenders to keep raising debt as we go along, The co-lending gives the extra cushion coming in, and you can then build a better lever model. In fact, interestingly, we showed almost 6x lever before our last funding round, just to show that, listen, if push come to shove, can we generate much better efficiencies? And we demonstrated that. Of course, today we are not that well levered. We have more than 1,000 crores of net worth, we're, uh, and we're also profitable. But as we are growing, lever is very important to demonstrate so you can really build a larger outcome.
Okay. So you said your asset under management is 3,200 crores and your net worth is 1,000. So you're currently at a 3.2 kind of a lever.
Yeah.
What is the difference between balance sheet lever and co-lending as a lever?
So
And
co-lending is a liquidity tool. There's no difference. Co-lending or self-balance sheet,
but
the
the
rating agency and lenders say it's one. Margins
margins would
also
be
exactly same, almost
exactly the
similar.
same. Okay.
Yeah, it's just a leverage option. There are
Okay.
different type of capital providers in co-lending and different types of lenders on the direct lending side.
So I would have thought that when you are doing on balance sheet, then you borrow at, let's say, 10, 12%, and then you lend out at 18%. So that 6% is there. Plus, you remove your NPA cost and your own cost of operations from that. So that is your margin there. Whereas when you're co-lending, then the person who's lending with you would give you some sort of a fees for loan origination.
Uh, so this is where some of the models differentiate. Some of the companies prefer pure synthetic, which means that they're not trying to be the lender. They're trying to be the platform. We believe we were a little fortunate from day one. We had a well capitalized NBFC. So we said, no, we will prefer to do classical 80-20 leverage. And we were also fortunate to then work with very large financial institutions who came and said, listen, we understand what you're doing. So we like the mix that you do. You do 60% on your own book and you do 40-50% on co-lending. It's a very healthy mix. And this looks like the way today business can grow well, and we can build in the leverage model coming in.
So even in co-lending, they give you a percentage, like whatever, let's say 5% is what you're ideally targeting. So they will give you a 5% for the
Oh, yeah,
money
yeah.
which they are
See, no
disbursing.
co-lender
Yeah.
should ever lose money. The day he loses money, the credit line disappears, right?
Mm.
The risk belongs to us. That's very clear. It's how you adjust the risk and how you manage. Of course, the 5% FLDGs are given to manage the entire infrastructure, but we definitely operate below the 5% to kick in. That's the important part. You need to operate much lower credit cost in the entire model.
Um, what is so I didn't understand what you just told me. Much lower credit cost. Your credit cost is that 10-12% which the bank will charge
No,
you
credit
or
cost is what
interest.
we lose, money that we lose when we lend to a consumer. Borrowing
Okay.
cost is when we borrow from the bank.
Okay. Credit cost is your NPA essentially.
Yes, it's
Okay.
your NPA, correct.
Non-performing assets, the bad debt,
Yeah,
people who don't pay back. Okay.
correct. But the
So
NPA has
that,
to be then, let's say, annualized to calculate the credit cost because tenures are different, etc.
okay. And what is your current credit cost?
It's lower single digits. So we're very healthy in this entire part.
Okay. Interesting. Okay. Uh, what is the reason why your leverage was 6x earlier and now is 3x?
Oh, it was just to demonstrate we were raising around. Typically upward, we prefer to run this model at a 4x level,
Why
right?
is
So
that? Why not? I mean, the higher you go, the more money you make.
5 would be the maximum you should lever at, right? Before 4 is where you get uncomfortable. See, we also have a lot of corporate governance which has to be maintained. End of the day, remember it's a risk business. You can't go wrong, right? And you always have lenders whose money always has to be given back,
Hmm. Okay.
right? So we prefer to, let's say, every time we cross 4x, we like to go raise more equity to build the cushion before the 5x have the money. The last time we were raising money, we knew the term sheets in our hand were there. It was taking time to close out because a very large round happening and very complex PE funds coming in. So we said, why don't we show? Listen, if there is availability of co-lending, can we build something larger? And just to showcase that, listen, if push come to shove, we can always build a larger outcome without too much of capital.
How did you hit 6x though? What you said is even in co-lending, the 5x is the norm.
No, it's allowed. No, in co-lending, you can go up to 10x actually.
Okay. Okay. Got it. Okay.
Yeah.
Okay. Interesting. Okay. And how much money have you raised till date?
We have raised close to 136 million in equity and almost 700 million in debt.
Wow, amazing. Okay. And for you, the 136 million fundraise, I mean, there's a different way of looking at it. Where, let's say, if Byju's raised 136 million, it means that that's cash they raised to burn for customer acquisition, building
So we have
product,
never lost
etc.
a single rupee. All the ones, uh, 136 is lying as capital with us and lying as net worth in our financial entity. That's the
Right,
interesting part. We have never lost a single dollar.
right.
Maybe what we raise in the first seed in the first year, we're too small and we're trying to build an organization. But apart from that, never a single rupee has been lost. We may have lost $1 million during COVID, right? But that's it. We today generate, I think this year we should generate upwards of, let's say, 115 or 112 to 115 million PAT. So we're actually doing a very good job of generating large amounts of PAT. We have crossed the $1 million monthly PAT number.
Wow, amazing. Okay, that's phenomenal. And so essentially, money is just an input for you because you're lending out money, so you need money, and that money then you're able to leverage 3x of that or 4x of that, ideally, so that you are earning better return on the money which you're lending out. Okay,
Absolutely.
okay,
Absolutely.
okay, amazing, amazing. So you said your book is 3,200. What would be, let's say, the book size of the biggies, like say an HDFC or a Bajaj,
Oh,
in the
this it goes in lakhs of
unsecured?
crores. It goes in lakhs, and Bajaj is the 4 lakh crore balance sheet, right? So it's a
For
very
unsecured
different
personal loan? Or
uh, overall book. I think unsecured, the personal loan segment would be 20% of it,
okay.
right? So if I look at it is a $3 trillion market in India, right?
Wow.
Growing at 30%.
3 trillion,
Uh,
all loans or unsecured personal
just
loans?
unsecured, right? So it's a
Okay.
huge market, and that's the opportunity that we are all going behind. Of course, the segments are different. There are going to be people like you and me who will borrow maybe at 11, 12%, for which HDFC Bank comes into picture. There are going to be people who are borrowing marginally higher, and that's where the every player has his own slice. Every player has his own risk model, cost of capital model, and that's how the model then evolves to really build out something better.
Okay. How do you manage risk? And because you are also lending to new to credit where there is no CIBIL score, I'm guessing when someone has a CIBIL score, then it would be a relatively more straightforward way of managing risk. Then, like the CIBIL score would feed some sort of an algorithm which would throw up like this is the risk profile and this is the interest that should be charged.
So very interesting. While we look at the bureau, we have our own scorecards. We decide yes or no and put the customer prediction model. We run two types of scorecards, and each scorecard has maybe four different versions running parallelly. So almost 8, 9 origination scorecards are running, and each of them has then 7 various categorization within the scorecard. Some of them are very complex. There are more than 5,000 variables in these scorecards to explain to a human mind anymore. In the beginning, they were still easy to tell. They become more complex. But let's say if a consumer has bureau presence, we're looking at how is his credit history been, where is he spending money. Uh, and we also try to then enter into account aggregation and look at his bank statements for the last six months to understand how is he spending, right? So this is how you look at analyzing a lot of data about the consumer. And of course, it's also a lot of other data then comes in to look at, because you've done, let's say, decisioning to almost a crore Indians, you have really powerful data segments then created how to lend, how to run risk management. See, typically, if I look at classical banks, they may be large, but they really don't have large customer bases who have applied to them, right? And interestingly, over the last 6 months, more than 30 million people have applied to us,
Mm.
right? So the database, and we have captured maybe a crore bank statements. So analysis capability is phenomenally large. So we can look at bank statements and say, listen, these two statements look very similar, or 5 transactions look similar, looks like some fraud happening,
Mm.
right? Or people who work in X companies, we know when and how do they get their salaries. If they need nomenclature changes, we can catch that.
Mm.
So
Okay.
scorecards are one element, but also then the engines on top of it to build rules and build risk engines and put fraud management systems allows you to run business at scale.
Mm. Okay, fascinating. Uh, what is the account aggregator framework for people who are unaware?
So typically, if you remember, you have to provide a bank statement. It becomes more difficult. You download a 6 month statement and you upload a bank statement. The AA is an easier way. You can add up using net banking or Aadhaar or the AA sign in. And today everyone is getting accepting through their banks to become accessible to A. Today, almost 23 banks are on A. It makes easier access. While using net banking, almost 97 banks can give you access to the same 6 months bank file.
Okay, so through account aggregator, you can authorize the loan provider to uh, get
To
your
get access to
bank
your data,
statement
it's much
directly from the
faster.
bank.
Correct.
Ah,
So let's give an
right.
example. The app is so much easier today. You open the app, you answer a couple of questions, which includes it automatically answers your PAN number. The minute you select your bank, it says, can you just click your A access? Again, an OTP comes and you're into your bank. It just says now, give me your Aadhaar ID, and you're done. And a repayment instrument is also linked to the same Aadhaar ID, right? So in a way that 122 seconds, when you're doing all these, the loan is approved. At the back, we're not taking more than a second,
Hmm.
right? But the
Yeah,
question
because
really is that you
through
are doing these
API,
steps
you're
to get
fetching the
money,
data. Yeah,
right? So
yeah,
while
yeah.
you're answering everything, you can calculate at the back. And this is why the engines become faster, better, quicker to get that disbursal done for you.
Okay, okay, fascinating. What are some of the other ways in which you are the fact that you have access to so much data helps you in better risk management?
So our biggest tool that we run is what we call as a behavioral scorecard. See, we are not underwriting to you once, we're underwriting to you all the time, which means that if you decide to go over lever on your credit card or some other loan, or you decide to go to a very expensive lender, I can decide to cut your line out. Or I can decide to listen. I saw you getting over levered or taking too much of transactions on your ex bank credit card. I can give an offer to you. Listen, I'll pay off your card. You can't anyway pay it. It's too expensive. I'll pay off your card. Instead of paying 48% there, I'll give you a 12% or 18% personal loan, and just pay off your card for next 12 months. Don't be in a panic mode. So this is the
Mm,
capability of the behavioral scorecard, which runs on the consumer. It can manage the customer better. It can make sure our portfolio is healthier. The scorecard keeps removing, let's say, 1-2% of the worst customers, but it upgrades a fair segment of our customers. Nearly, it upgrades half of our consumers each month, right? And this allows us to deploy more capital on the same repeating customers. I did mention we have a repeat rate of 88%. That's because the scorecard is pushing these consumers to borrow again.
mm,
And when they come back, they see a cheaper product. They almost see 3 times higher limits,
mm,
right? So he goes from 50,000 to almost a lakh 50,000 rupees. He goes
mm.
from let's say, uh, an X interest rate to now 40% lower interest rate, right? So consumers happy, everyone's happy. And interestingly, the behavioral scorecard were able to reduce the risk by 3 times. So why I gave you a better offer is because my risk came down by 3 times. And I think this is the singular reason why, let's say, Fibe is considered a better lender, that we run a very strong back-end driven continuous underwriting model using a behavioral scorecard.
What is feeding the behavioral scorecard? One is because the account aggregator gives you access to past data, and that's it, or you can continuously keep getting access
Actually,
even after.
you can get in the AA platform continuous bank statements for the consumer. We today are moving to that framework. We haven't yet switched it on. But the more important is we are pinging your bureau and getting the updated bureau file regularly. So every customer is redecisioned every month, and the bureau data is completely redone. And that gives us the largeness of the entire pie to manage systems, look at the entire pie, and rerun the business.
Okay, okay, interesting. What data does the bureau have about me as a consumer?
So uh, performance data on every single credit product that you carry, from your home loan to car loan to bike loan, to every application that you make to every lender, and how your repayment history is across every instrument. So did you pay this month? Which day did you pay? Was it late? Was it not late? Did you have any overdue? All of that the bureau comes in.
Okay, when you say performance, this is what performance means, like the repayment behavior.
Yes.
Okay, Okay. And if you're applying for a lot of cards, then that is also like a red flag. It means that you're in stress or you need money.
You are too desperate for money, and why you're getting rejected from so many other places? What happened suddenly?
Hmm. Okay, cool, cool. Got it. So help me understand the lending ecoscape, the lending, I mean, the broad space here. There is a the NBFC, and then there are fintech players who are not NBFCs who are also making money through lending. What are the different types of players in the lending space?
So I think let's first divide the universe into digital lending space and physical lending, right? In the digital lending, that the regulation has become more clearer for consumer to understand. There is a DLA, digital lending platform, right? There is a TSP, which is a transaction processor who could work with the DLA and the regulated entity. And the third is the RE, which is the bank or the NBFC finally giving money, right? So the three players come in the ecosystem. The RE is common in physical and digital world. Uh, you could be a only digital, you could be a phygital, you could be a physical. The RE provides the money at the end of the day. In the physical world, you have branches and you have DSAs, or you have someone who creates a lead, someone who services a lead. In the digital world, the digital lending platform does the job of the DSA, right? And talks to the consumer, works on the consumer behalf to interact with the lending entity to the conversion. In our case, we are all three. We are the platform, we are the TSP, we are the lender ourselves, so that the journeys are more seamless. It's not like, oh, I found you at 2 o'clock at night. Now let me go and find who will give you money. When I find you, I give you the money.
What would Paytm be? Paytm also does
Paytm would be
unsecured
LSP. No, he's a
personal loan.
LSP. He's only the platform.
Okay.
So we are one of the lenders there.
Okay. 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 And when you say you are the largest lender, you are talking of the REs here, or even like say what Paytm lends, you are lending
So
more than.
if you go to Paytm and if you look at loans under 100,000 rupees, you'll find it says powered by Fibe,
Okay.
right?
Okay.
So
Okay.
it's us only who's running the engines. Our API stacks are deployed there. In fact, if you go to we have we have almost 44 large partnerships where whenever you go online, you may be borrowing there. You'll suddenly see a line which says powered by Fibe.
Interesting. Okay.
Right? So it's our APIs driving the entire stack there. We have been able to, let's say, build a capability without our mobile app, just on API to manage the customer. So the entire infrastructure then comes on the API platform to build up.
Interesting. Interesting. What do you pay Paytm then when Paytm is originating a loan?
So he's a distributor, right? So they're all coming in as classical LSP distributors. So they get a distribution fee,
Is that like a percentage of the amount dispersed, something like that?
percentage of the loan dispersed. It's like classical, like a physical DSA or a web aggregator. The same way is followed up there.
Like
On
a single
conversion, you
digit,
pay an X fee.
low single digit kind of a
Low single
percent.
digit, absolutely,
Okay.
absolutely.
Okay. Okay. Understood. So you all your lending happens through partnerships, or do people directly also download the Fibe app to apply for a loan?
No, the largest is the Five app. The Five
Okay.
app is the largest sourcer of loans for us. It is the largest sourcer of lending to salaried individually as a platform. That's why I say
And
Five is the largest salaried platform. The app is known for that purpose. No partner of ours is more than 5% ever,
okay.
right? And every customer is managed on the Five platform, which means you could come from anywhere. The loan you'll repeat will happen here. The servicing will happen on the Five platform, and we will give you more and more products as you go along.
I would have thought that the fintechs like Paytm would want the engagement to happen on the Paytm app only, like repayment and stuff
So
like that.
you yes. So let's say some of our partners, let's say GPay, some of our partners with some of the distributors, we've been able to build uh, many capabilities on their site. But many a times we prefer, but the use cases complexities are too many, and we prefer to handle the customer at our end then.
Mm,
Let's say when you go to a Pesa Bazaar or India Lens or a, let's say, Buddy Loans, etc., they may be originating. They'll have all our APIs sitting there, but we keep the dispersal sitting on the Five app,
mm.
because the app is then become the singular, um, let's say, communication engine. what our consumers like is the simplicity of our platform, right? When you come to us, you'll never receive a phone call,
Right. Everything is digital.
right? So that's the first component, right? That's the assurance that we are giving him that, listen, we're going to treat you well. We're going to keep providing you financial products, but it does not mean we're going to push down some other third party product, trying to sell you something else, trying to be every day calling you up. It'll nudge you a few times if you're interested. If you're not, it'll say, come back when you want something else, right? What we see, a consumer likes us for the simplicity. It's a sophisticated product meant for younger, sophisticated consumers, and at least on the demand and side, we seem to attract a very large consumer segment coming to us.
Mm. Okay. Your collections is also pure digital. How do you ensure the collections happen seamlessly? Because I mean that's the key, right? To keep your credit
Yeah.
costs or your NPA low, you have to have a strong collections engine.
So very interesting. See, if I look at, we collect digitally as the first foot forward across the way. There is no physical way of paying us. We don't collect cash. We have no other instrument coming in. When a customer borrows the first time, we set up a repayment instrument. It could be a physical natch or a Aadhaar natch, an NACH natch, or what you call as a UPI based natch coming in. Right, it's set up on the platform immediately when you borrow.
What's a natch? Can you give a 101 on that?
Uh, Natch is like multiple checks being presented by a consumer. Uh, it just allows every month deduction to take place. It allows us to debit once a month the customer EMI, right? Without every time seeking approval every month or the customer not presenting a check to us,
Mm. Okay. So
right?
with an Aadhaar natch, you any bank account linked to the Aadhaar will get debited. Is that how it
Yeah.
happens?
So
Or
the bank account in which you sign in, provide the bank statement, and it's the same account that we transfer money to, and the same account we recover money to.
okay, got it.
Right. So we maintain relationship with a single account of the customer. We like that account. We gave you money on that account. We want money back from that account.
Mm. So for a large portion of users, like I'm guessing more than 90%, this is it. You don't need to do anything more than setting up a natch.
Correct. What's interesting is I told you that we uh, recommend a consumer to come and pay back anytime, and there's no foreclosure charge, and we charge per day. What's interesting is, let's say you NACH date may be set at 5th of the month, and this month your employer was kind enough and give you money on 31st. You'll be surprised that 50% of our users come and pay on 31st and save that 5-day interest. And
Right.
that's a very interesting behavior that we've been inculcating with our consumers, and we see that come in quite well, and we see our customers being quite happy doing that behavior.
Is it seamless that if you've prepaid, then your NACH will not get debited, or do you need to like also cancel the NACH for that
No,
month?
no, it's absolutely seamless. See, we
Okay.
have to manage at least, let's say, 700,000 payments every month, right? So, and our operational efficiency will go away. It's just too many transactions happening. We run it. Our entire company is just 720, at least 731 employees as on today. Right now, to run, and this is when we are lending, collecting in, I mentioned 321 cities. Running business that deep, everything has to be fully automated, well run. It has to be like a well run engine, right? There no parts can have breakages in them.
Amazing, amazing. So for that single digit percentage where the NACH doesn't work because let's say the account doesn't have balance in it, what happens then?
So you start getting nudged, let's say, by the bots, and then followed by polite callers, and then little bit not so polite callers. But let's say in the first 30 days, we collect ourselves to build the efficiency between us and the language callers that we manage. We are able to recover from 85% of the single digit who didn't pay on time. Right? That makes it
Okay.
very efficient. Interestingly, let's say an average EMI amount is close to 8,000 rupees for us, right? Which means we're not really recovering 1,000 rupees from a consumer. So when, let's say, the portfolio is crossing 30 days, even if you outsource to a collector who may be present in your city, may ring your doorbell or first call, he finds it very efficient to call and collect or send someone to your house to collect, right? Because you're not really collecting 1,000, 2,000. It's like recovering on a car loan or a housing loan. So the efficiency in the model is much better.
Okay.
Typically, let's say what we call as classical hard buckets, where money is now needs to be recovered locally in your geography. We are still able to recover 65, 70% of, let's say, a single digit coming down to 85% of that. Then from that, another 60% can get collected, which makes the model very efficient.
Amazing. Okay. So 85% is collected just through a call with your in-house call center or an outsourced call center. And then the remaining 15% goes to a collection agency and they are also able to collect 60, 70% of
Yes.
that amount. Okay. Okay. Interesting. This 730 odd people, your head count, what is the split? How many people doing what?
So if I break up our teams, we'll divide our teams into two clear parts. One is the team who's building the platform, scorecards, product, and intelligence on that product. Nearly 40% of our teams are that. So high pedigree teams who build the platform, build their machine learning systems on it, build the product sciences behind it, or the customer journeys. Right. 20% would be the business operations team, sourcing customers, running financial operations, running underwriting, running operations. Right. And 40% would be the service and the collections infrastructure that we run.
Okay.
Uh, that's how I'll split the entire team structure in. What's interesting is typically the 20%, which I mentioned, in most companies, that's 80% of the manpower. This is what we have been able to digitize to reduce and build the operational efficiency. Uh, the we have 11 underwriters. We had 11 underwriters 8 years back. We used to do 1,000 loans a month there. Now we do upwards of 150,000 loans a month. So the efficiency in manpower comes when you build digitization better.
What does an underwriter do?
He looks at the cases where the machine said, I found a problem. I'm not yet authorized to approve it. Please eyeball it.
Okay. And
Right.
that
So
would be
around
a single
5% of our cases get
5%.
eyeballed.
Okay. 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 Got
The
it. Okay.
decision is given by the machine already.
Okay. Interesting. Interesting. And whatever decision the underwriter takes would again keep feeding the algorithm so that such cases in future are also automatically decided.
Yeah. It's also the type of underwriters that you appoint. Our underwriters are groomed to teach the machine learning team what they found. I don't want to see that case ever again.
Right. Yeah. Obviously.
So it's also how you build your team culture. Either you are saying, no, you're just doing underwriting, or you're saying that, listen, you want to eliminate the function. And all of you then figure out how to do it more efficiently and better.
Okay. So there is this metric which most VCs use to measure a startup, which is like the customer acquisition cost over the long term, or the long term value over the customer acquisition cost. Uh,
LTV to CAC.
yeah, LTV to CAC. What is that ratio like for you?
It's 5.5 times. So
Wow.
whatever is our CAC, we will generate 5.5 times within 2 years. That's the first component. Interestingly, financial services, the let's say terminal value of a customer can be phenomenally good. Let's say terminal value for a customer to us is almost $400, and that's the
Wow.
magic of the high repeat rate.
Right. Yeah. 88% repeat rate is phenomenal.
Correct.
Yeah.
It's not that we're earning small when we originate him, but because we retain him for a very long window, that allows us to really have a large revenue on that customer side coming in
So this 5.5 times as the LTV to CAC ratio, what would be
within 2 years.
within 2 years? What would be a comparable number for other companies, just to understand? Like,
So, it's very interesting. You can have similar matrices, let's say in e-commerce, right? But let's say there the GMV on the customer would be $20, right? Here it'll be $200. So the
okay.
5.5 means 16,000 rupees. It does not mean uh, a smaller amount. That's the fundamental difference.
Right, right, right. I think for the D2C space, generally, this is about threes, right? This,
It's almost touching four. Many of the 4.5 is what we're seeing the most successful ones come in. But
okay.
again, there the income per customer is less than $10,
Right. Yeah. Yeah.
right?
Yeah.
And so this is a very different orbit. Can you generate $400 at a customer income? That's why financial services are very complex businesses and they're built for lifelong. It takes time to build. It's not that in 1 year you can achieve those numbers. It takes many years to build the book and profitability. But once it gets built, you're there.
Okay. So there are two ways to make this ratio go high. One is, of course, you increase the long term value by making your product sticky, repeat usage, which you told me you have 88%. Second is you reduce your cost of acquisition. So, what have you help me understand your customer acquisition strategy? What are the ways in which you acquire customers?
Our primary marketing is what is, so there are two ways of acquiring first. One is what we do directly. And in our direct engine, we are working with, let's say, organic, Facebook, Google as our and affiliate partnerships. Here, it's all performance-driven work happening. We are one of the highest rated lending apps. We target consumers in a geographic neighborhood. For example, if you are a borrower in Bangalore between 22 and 28, the chance of you to see my ad is almost every day for the next 30 days is very high. You happen to be an, a 35-year-old, see my ad may be impossible. Right? That's one way of sourcing. The second way of sourcing is visibility in every financial platform. So it could be looking for money on aggregators and DSAs. It could be approaching your bank for money or approaching your current financial institutions. Interestingly, we built a very interesting channel where your current financial institution can't give you 100,000 rupee loan. He refers the customer to us. That's also becoming a very powerful franchise that, listen, my customer, I'm not okay to lend to him small amount. Can you do it because your efficiencies are better? And then we bring in the co-lending to do it together along with him.
Oh, wow. Interesting. And
Right. So
who are the
discovery
partners here?
becomes large.
Offline
Well, we
partners?
have a couple of banks. We have a couple of large NBFCs. The top two largest NBFCs, and I think fifth and the sixth largest bank are doing some pilots with us and really building in good volumes.
Wow. Amazing. Okay. Okay. So o- you also have another way of acquiring customers, which is through BNPL, right? We had like a previous discussion where you were talking about some of the new initiatives that you've taken in the last 2 3 years. Help me understand that. I'm guessing that BNPL is also, in a way to acquire a customer.
Oh yeah, BNPL is a complete way of only acquiring customers, nothing else apart from that, right? Uh, I'll answer it in a slightly more better manner. My definition of BNPL is where we are able to manage uh, a use case for the consumer, but at the same time, we are able to create impact and improve his life. We are not financing mobile phone purchases and holiday and let's say spend behavior. We are financing improvement in education, improvement in skills. We're powering better healthcare and better health insurance, right? And also trying to improve your life if you want to have children, if you want to have a better appeal, better health, etc. So let's give areas that we are available. When you decide to upgrade your skill set, if you go to an upgrade scaler, you'll find us as a zero cost EMI partner. If you decide to walk up
And
to a
one question
hospital,
here. So, how BNPL or buy now, pay later typically works is the seller, which is like, say, an upgrade or a scaler, will pay you some money. I mean, they will bear the interest here, right? That's how
so
it's
this is the
shown as a.
classical Bajaj Finance model where there's a margin adjusted between the manufacturer and the lender so that the consumer doesn't end up paying in large interests on it.
Right. Okay. And this is
Right.
called a subvention in
It's not
the
a subvention, correct?
industry jargon. Right. Okay.
Yeah. So one is the education space. Similarly, if you walk up to a large school, you'll find the monthly fee payment being powered by us, enabling parents to make the entire transaction. If you walk up to a leading hospital, it could be a maternity hospital or a large surgery hospital like Apollo or let's say Narayana, and you'll find we are available as a 24-month zero cost EMI to enable surgeries for you. So we are looking at areas where impact is possible, right? We're not financing use cases which are frivolous. At the same time, we are providing uh, elements which enable you to live better, either improve your income, look after your children, or look after your health.
Hmm. Okay. Okay. Fascinating. How big are each of these practices?
So
The
we built out this vertical post-COVID. So they're very new. Uh, I would say they're now adding 20% of our incremental customer profiles are coming from them. So they're really grown from zero. Remember, the core cash business has grown 6 times or maybe 10 times since COVID. So anything to become 20% of them is very large. I would say in the education space, we are one of the top two lenders in the digital space. In the healthcare space, we are the largest healthcare in the digital space. Uh, but I would say the others are just too small. The only physical player, we may be still 30% of his volume. So we have really built out a large company fast.
So the physical player would be like a Bajaj, I'm guessing here, which does
Correct.
healthcare. Okay.
Correct.
Okay. Okay. And so the education piece is something which I can understand how you would have built it up, because you need to crack a few partnerships, maybe a dozen of them with an upgrade, a scaler, and similar companies. And once that
No, the
partnership
schools
is
ones are very complex. You have to go school by school to tie up.
right, okay. So yeah,
Right? So that's
that's
a
what I
lot of
was coming from.
infrastructure to be built. And of
Mm.
course, the education industry also collapsed. Let's say the K-12s completely collapsed. So we went when 2 years back when we were starting this business, there were 200 ed tech players to partner. We also had 200 partners. Today we have
Wow.
11 active partnerships. We shut down most of them and said their models are collapsing. Let's only focus on skilling. That seems to be more rational. Or if it is a university powering the course, then we'll go and do something along. Because we said, end of the day, BNPL is a customer acquisition engine. You need to cross sell something else to make money. Uh, the salaried guy does skilling. He will need a loan later on from us. We become a good origination for him.
Hmm. Okay.
Similarly, we can also bring a large qualified customer base to digital skilling platform. If you're looking for, let's say, IT professionals in Bangalore, I may be having 500,000 people who have applied to me from that city.
How will you direct them to the platform? Like on the Fibe app, there'll be a
If
banner.
my, yeah, they'll be on the Fibe app. If what they see is when they go to the platform, you'll see payment options, you'll see Fibe limit already available. So then you're not figuring out what to do. The limit can be used straight away.
Ah, okay. And how does Upgrade or Scaler know that this is a Fibe customer which has this limit?
Oh, there are a
How
lot
is
of
that?
it's all integrated. There are lots of
Okay.
integrated play happening. Yeah, we're also available. Let's say on a couple of payment gateways between JustPay, Razorpay, we're available as a payment option.
But
So
your way of identifying a customer is through the Aadhaar or PAN, right? But when you're
mobile number.
through the mobile number, okay. So someone who's signing up at Upgrade would have given a mobile number for an OTP.
Yes,
So
yes. So
therefore,
that's one
through
way.
mobile
That's how
number,
you're able to
they,
validate.
right, right,
Correct.
right. Okay,
And
okay.
remember, I said we are the fastest lending instrument also. So even if it's a new to us customer, we can onboard him in runtime. So by that, it's like an e-commerce journey happening. You're choosing a course. While you're choosing the course, we'll approve you at the back end. So your entire transaction. But here, the
Wow.
important for us is the customer segment selection. You could do the same thing for mobile phone purchase, but the credit cost is very high. You end up acquiring a customer which most other lenders will reject. Here, we are financing a specific use case, so we know who we want, how we want to do it, and then we work very jointly with the company to enable its systems.
Right. A person who's investing in upgrading his skills would definitely earn better in future, and therefore would be a
Absolutely,
better
absolutely,
prospect. Right,
yeah.
right. And similarly, someone who's spending on school education for his kids is again a more stable household.
Not only household, what we have noticed today, parents like to send children to a notch above school than what they went to, right? And most people end up having two children. So let's say if you end up sending to a slightly better school today, you're talking about 1.5 lakh rupee per child into 2-3 lakh rupees to be paid on 1st April. It's impossible to pay in one bullet,
Mm,
right?
mm,
So converting into a monthly mode just enables a better life for the parent.
mm,
It's also a consistency product. You start at nursery, you end at class 12, which means 15 years are built in and repeat. Remember, I told you for us, repeat is important.
mm, mm. Right, right, right. Okay.
So
Uh, the school product, a lot of schools don't even have a digital payment option. How did you integrate and build the school product, the school fee
so
financing product?
yeah. So we realized that if we had to go to school by school, it's too complex, right? Where school owners are different and school principals and admissions are different and people, right? Money is run by the owners while the admissions run the school. So we went through the ERP route. We have taken the top ERPs and top school payment integrators and done direct integrations with them. we realized there were many challengers in this category. They wanted to go school by school. I think it's a very slow journey trying to convince a 40-year-old institution to have something new will take you 18 months to close. But they all have ERPs in place. So we just piggybanked on the ERP network to really speed up the distribution there.
Who are the major ERPs in the school space?
So we have Teachmin, Class 365. So we have a couple of, we have EastBus or JustPay, etc., who've done some work at the back end. And we're using all of them to integrate faster to come back with a distribution reach. I think there's no point entering a category where you don't service, let's say, the top 2,000 institutions. So and schools are also segmented, right? Every 5 kilometers, there's a big school. And so India has a huge population. So you have to go and build partnerships and build distribution.
Okay, fascinating. So I had previously interviewed the founder of Leo One, which is also into this school fee financing business. So they have their own ERP, which they are selling to schools. But what you're saying is doing that means a slower scale up, because you have to go school by school, convince each school owner.
Absolutely. See, the ERPs need to monetize, right? Lending is always the best monetization. And remember, lending is a complex business. You can't be something else and a lender. You need to be a lender. If you're doing anything else, you can never be a successful lender. It takes just too much of time, energy to run that business.
Right. Okay.
Right? It's a precision business. So and the company gets originated to manage that one piece better.
And how have you done the healthcare lending?
So healthcare was a little more tougher job. This was actually a category where first we had to go and learn what's happening. We run this in two ways, or three things. One is any type of healthcare which got digitized. So from Pristine Care to Healthify Me, those type of players to work with them. Pristine Care is a great example. We work with them. To anything which is new age, catering to younger people where insurance doesn't cover. So less sex, smile and teeth improvement, hair care, IVF, where we found the younger consumers, let's say people between 25 and 35 will use. We've gone and partnered them out. We have today 2,500 physical touch points where they can use us, including dental centers, including let's say hair transplant companies, IVF companies, etc. And then we built out the physical hospital business. We're still building it out. We're only live, let's say, in 200 hospital locations, only in 7 cities right now. Very complex, very tough to do. But I think it's so impactful that we are happy to invest our energies. The softness in the brand has come. I would say acceptance that we are doing a high impact work has started coming in, right? Typically, and many learnings came in when we entered the hospitals. Like we don't talk to the finance department, we talk to the surgeons in the hospital. The product team running this vertical is actually doctors. We hired doctors to build this business out.
Okay.
We said, if we go to the finance department, we'll only negotiate pricing. We'll never create impact. They look at us alone. But the minute we spoke to surgeons, they said, listen, I want to do better surgeries. I want better treatments to happen. I want patients to be better taken care of. And there, I think we built out a product, distribution, many more things behind it. And we're seeing scale come in.
So you don't necessarily need the hospital buy-in, because the hospital doesn't
You
care.
need the hospital buy-in because the subvention has to be paid by him. Right? But the instead of again, I'll give an example. See, in a medical emergency, someone will create money. Don't worry on that part. Right?
True,
it's only when you are getting a treatment, you want better treatment. Right? You're not talking to the billing desk. You're talking to the surgeon or the doctor. So this doctor pings us and say, listen, I like this customer. Can you give him something? Can you approve him a larger limit so I can do what I want to treat him for?
Okay. Interesting. Okay. And how is that happening digitally? Like, do they have an app or something?
So there's a QR code. The QR code enables a digital asset, which invokes, and that digital asset then interacts with the hospital management server, so that we can originate like authorization. So we issue an authorization to the hospital, say, I like the customer, I'm willing to give him 3 lakh rupees, you start the treatment. Whenever the bill is to be created, I'll transfer money.
The QR code
it's
will
like
be
an
on the
insurance
surgeon's
authorization
office, and he can just tell the patient, scan this QR code, and something like that would trigger. Okay.
Correct.
Okay. Fascinating. And this you have to go hospital by hospital. There's no easy way to
This is what we have to do
aggregate.
hospital by hospital. Yeah.
Mm, mm.
So this is
No.
where I think the first time we're learning physical and we're learning distribution as an organization. We have never done it before. So
Mm,
lots of learnings, hiring people, never used to having low-end people, how to track are they in hospitals or not in hospital at 9 o'clock in the morning, how many patients they met, what was the interaction. So that's where I think learning curves of every company comes in and we're enjoying that new phase.
Uh, you need your team to also interact with patients, like just to help them through the navigate the process and get the loan
No, the
approved.
journeys are fairly simple. You don't need it really. But our teams are available because, let's say, in a hospital atmosphere, people are too stressed.
Mm.
So, to reduce the stress, you'll find some of our team members there,
Okay.
but not really enabling
Troubleshooting,
business.
escalations, things like that.
Yeah. So, sometimes what happens is, see, the patient can't be the one filling up the form, the family member is.
Yeah, that's true. Okay. Mm.
So, at
Right.
that point of time, that we have to manage things.
Mm. Okay, interesting. So 20% of your customer acquisition is coming through the BNPL products, all of these. I'm assuming these would not be as profitable as the unsecured personal lending products. Like the the revenue contribution, margin contribution would be much lower than 20%.
No, see, I mentioned they're interesting business because there's no CAC. When you
Yeah,
source
there's
the
no CAC.
customer yourself, there's a CAC. In BNPL, there's no CAC. So it just
Okay.
adjusts. I also mentioned that you're acquiring may for purpose of cross-selling, then the same repeat rates has to come in. So you generate, it's a feeder business to acquire customers. It also removes the monoline capability that you don't have a single monoline and you're not only attracting people for one single product.
Mm. Okay. But this would not be like a product that would have like a 18% kind of a rate of interest on it.
It will, in many cases, it will have
Okay.
because here you're also the let's say the manufacturer there is going to arm twist you because he's the big boy in the room. But many other use cases, the risk is also phenomenally low. The credit cost is not even in single digits; it's very low to manage the entire base.
Okay. Interesting. Okay. So, can you tell me about the journey of building it up? Now, uh, what made you the right founder to start this business? Let's start with that. Give me your background, and what made you the right person to do this.
Yeah, I think everyone is right at that point of time of what they want to do. I think it was a time where we had enough experience. Maybe I'll take you through my pedigree and I'll also cover my co-founder's pedigree. So I was the youngest CMO in India in a large organization. I ran sales and marketing for Bajaj Allianz. Then I moved in to set up Policy Bazaar with Yashish. And then I ran Future Retail as their CMO. So ran retail sales for the largest retailer where almost 50% of modern retail was controlled by one company. So
Yes.
the exposure level was very early. By the time I was 33, I said, let's go and set up our own company.
Wow.
I had so it wasn't that I was going through the grind slowly to learn. I think I skipped at least 8 bands of work culture because of hyper growth very early. But that gave me exposure how to run very large financial institutions, early stage startups which are very well funded, and then run large retail operations across the length and breadth of the country. Right. So that gave a great knowledge level how to build a consumer product. On the other hand, it's a risk business, and Ashish, my co-founder, used to be the CIO for Bajaj Allianz and manage an $8 billion portfolio himself. So he understood macro risk really well. So when the two of us are best friends for almost 22 years, we met and I think we timed the market to perfection. People in the circuits were talking about banks have to be disrupted. Fintechs are coming out. There were some few fintechs in, let's say, in Europe coming in, some examples in US just emerging out. In India and China were the next big buzz that they could be something interesting. Paytm was also very small at that point of time, but lending was never heard of. You can give a loan on an app. So we were the first lending app in the country, right? Customer acceptance was extremely high. Of
And
course, we
your
did go through the
uh,
grind.
the original name was Early Salary when you started off.
Yeah. We, in fact, it was a name, first love name. the first people that we said we run out of money because salary is over. We said, if you get your salary early, would you like it? So we said this name resonates quite well. It became the category. Many of our competition started launching. We have an early salary type product.
Yeah. Okay.
So we said,
Amazing.
listen, we need to disrupt and say we do something more. Today, it's not that we have the same ethos that you can, whenever you get your salary, pay us back, but we do many things to impact your financial life better.
Okay. Okay. So, and this was 2015 when you and Ashish quit your jobs to start up. How
Correct.
did
And it
you
was,
like? Did you
so
initially use your own funds? Like, how did you build it up? That
I
tell me
think
about that
it was a
zero to
dream
one.
seed.
Mm.
It was a dream seed. Me and Ashish met I wrote the case study on a little tissue paper on Thursday. Friday met Ashish, took a flight to a friend who could build a mobile app. He made a one screen. Sunday met the first seed investor and said, okay, I'll give you $2 million in NBFC license. It was done. So then we
Wow.
had to figure out for next 3 months how to quit our jobs, convince our bosses and let us go. We seem to be happy. We want to do this. There is money. And then was moving to Pune, setting up a company, transferring the license, getting regulatory answers. Uh, and actually, interestingly, in 98 days of setting up the company, we launched the product.
Wow.
So it was a
And that
fast
NBFC
product out.
license was really the game changer. I'm guessing. Like very few lending fintechs start with an NBFC license on day one.
Yeah, I think that was very fortunate. The seed gave us the NBFC. In fact, he offered us, he said, I have a few of them in his family.
Wow.
Every time a child was born, they opened an NBFC. So we
Wow.
found one whose original name was Ashish Securities. जैसे ये वाला दे दो आशीष के नाम पे है.
Wow. Amazing. Amazing. Okay. Hmm. Right. Okay. So you started with seed capital and the NBFC, and in 3 months your app was live. How did you get the
Correct.
early customers? Like through Facebook marketing and all?
So we started off as a Facebook lender. That was the most interesting thing, that we positioned ourselves as a company who lends on Facebook.
What does that mean? Like the whole transaction happened on Facebook? Or?
So you had to open the you had to log in through social media,
Ah, okay.
right? So that was the primary way of accessing money from us.
And back then, I remember there was this big move that your social profile can be used to do credit rating. So I guess.
I think it was something that we created as a mindset. Listen, we are doing something disruptive and better and brilliant and fun. But we closely remember that it was us moving to introduce alternate data and social lending, and us then shutting it down to say, listen, we are a financial player. Let's be more rational. Cuteness won't take us anywhere.
Yeah. How soon did you realize that you need to shut down that approach?
I think the approach was never shut down. It was about, we have larger issues to go and solve, right? We're in a serious business, in money business, right? You need to really know what's happening in money. Uh, it, I think by the time version 3 scorecards came in, we were there. We said, listen, it's okay. We need to be better.
Mm, mm, mm. Okay. That would have been a year or two into the journey.
I think a scorecard, every year we have a new scorecard coming out.
Okay. Okay. Mm. And so, what was like a key turning point for the business? Like, if you had to choose one pivotal moment for the business or a turning point, what would that have been?
Uh, I think the biggest point was us running out of money every time helped us become better. That was one
And
of the most interesting part, that every time we ran out of money, we became better as a company.
so, running out of money implies that you have no more money to lend, so you cannot take on more customers.
Yes. So it just allowed us to say, listen, we need to work harder.
What were the ways in which you solved this problem? Was it by increasing the leverage or by going out fundraising or like?
So maybe, okay, let me just take an example of things that we did, which will give you a little bit more sight of structural work, etc., happening at our end. And see, when we started off, we had a small amount of capital. We started lending very fast, but we realized that we had to see maturity of portfolio, which made we wait for 6 months, and we didn't have money. So then we got supported by let's say friends and family who were in banking, and at that time RT came to our rescue and said, "Use my co-lending book." No one has done co-lending ever. No one heard about co-lending, but let's say Shriram Capital was the first co-lender to us, allowed us not to deploy our capital and create the runway to go raise Series A. When we went out to raise Series A, we were told no by 127 funds. They said fintech lending impossible. It's too cute, too early. The
Yeah, okay.
128th, 129th gave us money, and the 127th then came back and said, "I'll give you more." So we did 2 million, 2 million, 16 million back to back.
Wow.
Right. And this
That's a
was when we were running
phenomenal
out.
amount of resilience to actually hear 126 no's.
Yeah. And in fact, there were 30 IC meetings. IC is when you pitch the whole fund, right? The full day goes on those. And that was painful to sit through the end and someone saying, "We don't know why the IC is not clearing you." Right.
Right.
Because
Yeah.
reaching the IC is like 50-50 is done.
Yeah. Yeah.
Then
Yeah.
being
Yeah.
told
Yeah.
no 30 times, then you start wondering what you did wrong. But I think this is what uh, makes you entrepreneurs, right? You makes you really work hard to get what you want to do to happen.
And why was it that there were so many no's? Was it a ecosystem thing that uh, because I mean fintech today is like a hot category, a lot of funding, and I mean which was it that the ecosystem was not there to fund fintechs, or was it like there was not enough conviction in your category of unsecured personal loans or your approach of the social way and alternate data and all of that, or
Yeah, I think it was just too early. Many of them were because we were very early. The models were not matured.
okay, okay. Right. So you raised your next about you said 16 and 2, so about 20 million. Uh, and and then when did you run out of money next?
Then it was an interesting time. We had a term sheet and it backfired. It Something happened in that fund. They, in a way, lost their let's say fund manager, and the term sheet just disappeared.
And this was
Right.
after the 20 million was raised, the next round
After
when
the
you were
20
raising.
million the next round, right? And luckily, we
And
had very good internals. In the previous round, Fidelity 8 Roads had come in. And then they anchored and said, "Listen, I know you were supposed to raise money, but at least half of that we'll still give you."
how much
Right.
were
So
you
we still
supposed to raise?
manage. We were supposed to raise, I think, 16, 18 million that time. We raised 10
Okay,
in that stage.
okay.
But that just helped us tie over. We were very fortunate to get that money. It was a month before, 2 months before COVID. If
Oh
we had
wow.
not got that money and COVID hit, we would have been in a very tough situation. But interestingly, during COVID, we learned that we actually run a very good ship. We had the best customer quality. We had the least moratorium request. We had the highest repayment rate. And we were able to bounce back in September again. Most lenders were off for that financial year, which
Right.
means there were a 7 month window. We had zero fintech competition.
Wow. And were you lending during COVID or you stopped giving loans?
No, of course, everyone stopped lending, right? But
Right,
in
because of
COVID,
the
we went and built
moratorium
BNPL. So we went
uncertainty.
and built a new company, right? We went and built a new company. We went and said that we will now lend larger loans.
The
We
which
at
part of the
the
BNPL the edtech part?
the edtech is what we started after.
Okay. Okay.
Uh,
Because during
like
COVID, edtech was the flavor of the season, and
Absolutely. So
right,
let's say when COVID started, we had a 330 crore AUM. End of COVID, we had 170 crore, 160 crore. Right. Our AUM ran down. We stopped lending, so
right.
focusing on collecting. Interestingly, in the next 12 months, we ended up at close to 1600.
Wow,
So
phenomenal,
we grew
10x.
10x when there was, and everyone was sleeping, and we went and really built out a franchise.
Mm,
We had a, we moved from the 1 month product to the slightly longer tenure products. We went with a much better customer quality, and we came out profitable. Right. End of the COVID year, we were profitable. Everyone was losing money, and we were profitable.
wow,
Right. So
amazing.
it came out of and this is where we saw when we went out to raise money, we raised 3 times the more money that we wanted. We closed our round in 4 days. That was the most
Wow,
interesting insight. That
Th-
four term sheets, 4 days, and we closed it.
wow. This is a 110 million round which you're talking about.
Correct. Correct.
Okay, okay, phenomenal. Okay. Tell me something. The BNPL products would also be leading customers outside your comfort zone to apply? Like, I mean, for school fees, you could have a 28-year-old, but you could also have a 36-year-old who wants his school
Yeah.
fees, a kid's school fees to be
Yeah.
funded.
But
So
it's
how do
usually
you?
what happens is by the time you're 35, you have figured out life. School, children are part of life, so you know how to manage cash flows. It's
Okay,
only when you're 30 and you have a child is when you're struggling, you're not earning that well.
okay, okay.
See, decision which school happens at nursery doesn't happen in class 6th,
Right. Yeah.
right? So that's the only difference.
Mm.
If
Okay.
decision, and this is where we come into the picture.
Right. You make the decision easier that you don't have to pay everything
Yes,
in one go.
yes,
We'll
correct,
break it
correct,
out for you.
correct.
Okay.
And you will acquire maybe slightly older segment customers also. But this is that you build other product lines, let's say the card vertical that we are building, then you can still cross sell that, still can have monetization, still can deploy more, and still make money on that consumer.
Ah, okay. So a 35, 40-year-old will not go for a personal loan typically.
Yes, yes. So you need
Okay.
other products to come in. And this
Okay.
is where the innovation takes place. What else can you do? How else can you manage things, etc.
Okay. Interesting. So what are the new products? So you mentioned a cards product. What is that product about?
So we are doing. So we introduced the country's first numberless credit card. Right. This is a very interesting product that we've been able to build out. Uh, uh, it's the first UPI-based numberless real-time issued credit product.
Wow.
Uh, so, for example, let's say we offer the product to you and you like it and you take it. You'll complete your KYC. The card will set up immediately. You can start using the card on the app. Of course, the plastic will come in some more time. The plastic is secure because there's no
And
number
how
on
much
it.
time does it take from applying to being
It's
released the
real
card?
time. It's all real time.
Okay.
It just
Okay.
VKYC has to be complete. So compliance has
Similar,
to be
like
managed
in minutes, you can get
in
a credit
minutes.
card,
Yes,
right? Okay.
correct, correct.
Okay.
Then comes the second component. Once you're approved, what are you doing at the back end for it? You're able to use the card immediately because the QR scanner is supposed to be used. Unless you don't need the plastic, so you don't have to wait for it.
Right.
Even if you
And
have the
any
plastic,
QR scanner,
the
like you can use Google Pay
UPI,
also, or
any UPI, yeah,
any
yeah,
UPI app. Okay. So
any
you
UPI
can
app you can
link the
use it.
card with your UPI app and pay through that.
Correct,
Okay. Okay.
correct. That's a great precursor to doing many more things. Also, this is a credit card; it's not a debit card, which means that you can pay with credit on a chaiwala, which was impossible today. He didn't have a credit card terminal machine. So
Right.
I think RuPay is being the new disruptor, and
Right.
we are capitalizing on the disruption to do things better.
Hmm. Amazing. Do you think this will stay restricted to RuPay only, or will Visa and MasterCard also offer this UPI linkage?
I think it'll. I think it will take some more time before other, let's say, card platforms have access to this.
Okay, this is because NPCI runs both RuPay and UPI, so therefore this has
Yes.
happened so seamlessly and quickly. Okay, okay, got it. So how do you earn through the credit card product? How does it improve your margins?
So this is not a program that we felt it's for margin creation. It's a program that I think we have created for customer acceptance and opening my app more every day. Right. Of course, there is a distribution fee. There is a spend ratio fee that we share with the co-branded bank partner. Right. But
What
the
is the
customer value
distribution fee?
proposition.
Like,
So when we sell, we it's not I in credit cards. I can't be the manufacturer. Only banks can be. So
yes,
here, Axis Bank is the issuer. So
okay,
he gives me a fee to onboard a customer. I'm cross-selling this to my customer.
okay,
The second is every time there's spend, I take some portion of the spend as my income.
okay.
But interestingly, the
But
customer
I
value
have a
proposition is
quick
very
question
strong.
on the spend part here. So uh, the spend, there is a like a 2% is charged to the merchant uh, on whose POS you swipe your card. But in this case, like you gave the example that you can pay a chaiwala through credit card, there is no MDR, their merchant discount rate,
Yes.
which
So
is
there are lower MDR or no MDR in very small transactions.
okay.
But let's say if you're doing a proper transaction, 2,000 rupee above, there is an MDR applicable.
Okay.
That's where the income is shared.
Okay.
I'll give you a few use cases where incomes are better. Let's say Most of our consumers are young. For them, e-commerce payment, Uber, Ola payment, Swiggy, Zomato is the primary engine they're doing it. All of them get a 3% cashback. So the
Ah,
customer value proposition is phenomenally better,
right.
right? Usually only the Amazon card gives you on Amazon, doesn't give you anywhere else. The Flipkart card gives you on Flipkart. Here it gives you on both. It gives you also on Swiggy, Zomato. It also gives you on Ola, Uber. So you have a very strong CVP from the consumer angle. I think we and Access jointly, when we built the program, I think for him, it is a singular customer type. All of them are salaried, right? They're all credit tested. It's not lending to an unknown customer. So this is like lending to his own corporate salary account customer base. He's not just originated the customer. So he's very happy to build out a strong CVP. And that's what the positioning that we gave to the bank.
But what's in it for Access? Because
He gets a customer, the spend is his and the capital is his. So AUM is his, right? He builds an AUM behind it.
okay, okay. The
So he's
outstanding
making
amount
money on it.
is part getting added to his
Yes.
AUM. Okay. Got it. Interesting. But Access, the real money for them would only come if people are revolving, right? Like the MDR would not be that significant. I mean, Access would really earn well only if people are revolving. Like, if they don't pay the entire amount in the same month,
Yeah.
then they
So I think,
carry
see,
it
we
forward.
are servicing I give the example, right? When you originate a customer, only a handful of them have good credit cards. After 2 years, almost all of them have multiple credit cards.
Mm.
So if Access becomes the first card, it automatically gets a share of the spend, gets a share of the revolve. It's a very good program from the bank partnerships end.
Okay.
I think
Banks are
he's able to
getting
get the
young
best
customers.
quality.
Mm.
Yeah, so young salaried customer, tested credit profile. I think it's a very good consumer segment.
Mm, Okay, interesting. What are the other products that you're working on besides credit card?
So I think we are doing three more things at the back. Of course, because we're doing so much work in uh, customer traction, we have started, let's say, doing attachment insurance. We're also applying for, let's say, corporate agents so that we can sell insurance properly to our
Okay.
customer segments.
Okay.
The next is we believe that because we have a UPI based app, we should also have the UPI scanner on our app. So we are trying to figure out the TPAP, which is the new flavor in the market, UPI Lite. Can we bring that functionality on our app as something new? We just introduced the CIR, which is the free bureau report to every customer every month as a traction product. And of course, we are building the offer management platform. I think we learned something from Cred that their customers then end up becoming great to buy specific product purchases. And we said, why don't we list those products on our app and see if we can also sell something? If we have a few million MAUs every month and the card program pushes the DAU rates, maybe they can buy something on our platform, which is more curated, more transaction oriented to these young people. So
Okay.
products like these are coming in the entire space.
And like Cred has that, like, you get Cred coins, and then some of those coins can be used when you're doing e-commerce on Cred app. So you're looking at something similar, or you just want
Yeah,
like
so we call it
exclusive?
gamification.
Okay.
We call it gamification. So I think many of these are were built because we built the version 3 of the platform. The version 3 is an interesting platform that we built. It allows us to load anything. If you look at the card, loads from nowhere. It wasn't there when you take the app, but suddenly it just comes from the back. Similarly, the gamification, the scratch cards, the coins, etc., are loads which will keep coming. The platform is built. We hoping that say by the end of the year, many of these functionalities will start getting introduced to the consumer.
Okay. So you'll have a Cred like experience where people can earn coins, and then some part of your spends
I
on
would say,
e-commerce can be
I would
reduced
say,
through coins.
building better credit habits could give you better benefits from us. We may not be like Credit's a payments platform. You come to pay for something there, so he incentivizes you to pay. Uh, we are a lender, so many of the habits will be linked to how you behave or the credit life cycle of yours.
Mm. Okay. Uh, eventually, I think most fintechs at a certain scale want to be a neobank and offer everything. So, like including
No,
wealth.
I don't think so. We want to do too many things. I think we are very clear that we originate a customer for a credit product. We want to make 95% of our revenues only on the credit product.
Okay.
Right?
You
So
don't
we are
want
not
to
doing,
go down to
we
wealth.
are not getting distracted. I think we are What we see is exits are possible if we do a good execution job in our business. We don't want to become a super app doing many things. We think our consumers love us for credit. Let's keep him on there. If he keeps coming back, we'll make more money.
Right. And what do you see as exits for
I
Fibe?
think emotional high for founders is always listing,
Mm,
right?
true.
We managed to get our debt listed. So we have a listed bond on BSC now.
Okay.
For us, the next emotional high would be, let's say, in less than 3 years, can we have an equity listing?
Wow. Amazing. Okay, cool. Cool. So I'm going to end with, like a this versus that kind of a rapid fire round. I'm going to give you two choices and tell me which one you prefer and why. A million customers or $1 billion?
1 million customers.
Okay, why?
I think the billion comes the minute you have them.
Yeah, okay, right. Got it. Okay. Friday or Monday?
Monday.
Why?
Oh, I love the energy to go back and say I want to do something fresh. I think I love going to office, and I like to see the energy across our teams. We're a rare company where people on Monday at 9:30 are fresh and happy.
Wow. Okay, amazing. Experience or energy? And this is with respect to when you're hiring people, building a team.
I think energy. I think today experience can be learned faster. If you are full of energy, you cause more work to do, and energy flow allows others around you to do better than you only.
Mm, okay. Uh, would you like to see your photo on Economic Times or Times of India?
No, I think I used to have seen it enough when I was growing up, when I was 25, 26. I'm okay if I'm not that visible. Uh, but I would say I'm still the rock star in the team. I still do many things for, let's say, visibility. But after learning a financial business, doing it quietly, hidden is much better.
Mm. So neither is your answer. You don't want to see your photo in either of these.
I, I think we evolved. When we were younger, I wanted. Now I can live without it.
Okay, nice. Okay. Email or WhatsApp?
WhatsApp.
And why is that?
It's faster. It's two-way. It's faster. You're not waiting for the other person to get your answer.
Okay. Amazing. Cool. So, any advice you have for young aspiring founders who are listening to the show?
I think very simple advice, right? You're going to face a lot of no's, very few yeses in life. Learn to appreciate when the guy says no and learn to appreciate when the guy says yes. Money is just very little in life, and time is equally less. Value both, and don't be in a hurry that things will happen overnight. If you are doing something, just keep doing that, things will become better.